if your bottom line is 10% of your business, having to increase your price by just 1%, it's going another 10% in your bottom line. Because what you've just done is you've increased just by 1%. That $10 has gone directly to your bottom line. So your profit might double if you just implement the simple strategy.
Today we're joined by Manpreet Singh, founder and managing director of Ace Biz. Manpreet is a confident and highly skilled accounting professional with a track record of working across both commerce and practice, supporting organisations from small businesses to multi-million-dollar companies. Since establishing Ace Biz in 2012, Manpreet and his team have redefined excellence in accounting by combining precision and innovation. With global expertise, experience in Big Four firms, and recognition such as Local Business Award for Outstanding Professional Services and finalist in the Sydney Young Entrepreneur Awards, Ace Biz has grown into one of Australia's most trusted financial partners. Manpreet specialises in SMSF accounting and audit, tax planning, business structuring and financial advisory, with a strong focus on leveraging technology to streamline efficiency and empower your business growth. He believes every business deserves more than standard accounting. That means delivering solutions that save time, cut cost, and reduce stress while helping clients scale with confidence. Manpreet, welcome to the Invest Smarter, Grow Faster podcast.
Thanks for having me.
That's good too. We've been talking about threatening each other to get on together, and I know our schedule's been pretty busy, so I appreciate you making the time to connect.
Thank you.
So, mate, how we normally start this podcast is I'd like to get to know you a little bit more, about your background, studies, what got you into finance, and then now obviously your own company with Ace Biz, which we'll talk more about later.
Sure. So who am I? I came from India in 2006 as a migrant.
Mm-hmm.
I finished my schooling in India, and then when I migrated here, I enrolled myself into Bachelor's of Accounting.
Right.
When I was doing my degree in accounting, I was few chosen ones, lucky enough, to get an internship in an accounting firm. It was a small mom and dad accounting firm based out of Parramatta.
Yep.
So I did my internship there for a year and a half. And as I was progressing in my accounting degree, I found a mid-sized firm, a job in mid-sized firm in the city. So I sort of moved to city and continued my journey in accounting there. And then as I progressed along a bit further, there was another bigger firm. I moved into a bigger firm. And sort of my 7 years career in accounting through these three firms, I figured, there's some challenges each firm's going through when it comes to serving clients or problems and all that. And that sort of gave me an idea as to what I want to actually do. It's pretty much helping small businesses. And that's when I decided, after 7 years of my career in accounting, I resigned one day and then gave myself a week start, and then that's where Ace Biz was born.
Wow, not much time to consolidate, or a lot of people do side hustles, but you just dove straight in.
Yeah, that was very different in my journey. When I speak to a lot of people, especially younger people in their 20s, 30s, people have gone through different jobs, 7 different careers. My career has always been a very one-line accounting. I've always studied one thing, which is accounting, in school, in uni, in my CA. My journey in my jobs have always been just about accounting. So not that exciting, but what we do is exciting.
Yeah, well, that's right. Well, yeah, there is a funny story that I actually studied accounting when I left high school.
Wow.
Then I was a bit rude, but I kind of found I had a personality, so I dropped out. So no disrespect.
Accountants do need a personality.
Yeah, but that wasn't for me. But I think I enjoyed the marketing and the commerce and economic side of the business degree side of things. So it was good to move on to that side and leave the accounting for you guys.
Oh, we need people in property, so.
Yeah, that's right. Well, that's later career. Yeah. So that's exciting. So what did you see? What are some of the key learnings, I guess? So you obviously took the good parts out of those smaller or mid-tier firms. You probably learned a lot about structure and process But what were the things that you took out? Maybe 3 things that are positive that you put into your business, and what are the things that you said, "I wanted to do better"?
Structures, the strategies that are out there available by big firms to bigger clients, and uh, most often they're not available to smaller businesses
Correct.
because smaller firms may not have that kind of exposure. That was one key learning that I thought the strategies that we could use to help small businesses grow. Um, I could implement those in my firm.
Mm.
The other major thing was technology. There's a big gap in terms of how small firms operate versus how large firms operate because they've got resources. Or small firms got heart, big firms got resources. The key is technology. And right from the beginning, when I started business, I had one thing written down very clearly that I want to write balance between how much technology I want to implement in my business to serve my clients better and how much of human resource I want to implement in my firm to serve my clients better. So having that right balance is important. And over the period of time, we focused to keep that balance very well, to deliver what we can deliver in a more qualitative and efficient manner.
Mm. Give me an example of that, 'cause that's really interesting because I think the traditional impression of an accounting firm is we just go and take our tax return there,
Yep.
we get it done, and we get a little return and happy days. But from a business perspective, a smaller business, but even a mum and dad, it is a small business in its own.
Yes.
A mum and dad can have a trust,
Hmm.
and they can run their property portfolio through there, their investment portfolio through there, which becomes a business because it's got an ACN and an ABN and things like that. So, what are some of the things that you've been able to automate in that environment?
So when we talk about businesses and of course mom and dad style investors, um, I think businesses go beyond just having to comply with their taxation or GST lodgements or BASes or annual financials. That's one part of the parcel that they need their accountants to do that. But above and beyond, what accountants do bring in their life or in their business is actually a strategy, structure, how they can grow in their life, how they can improve in their business, how the cash flow works, are they on a right track? So having to have that sit down with your client, whether it's an investor or small business owner or medium business owner, to understand where they are, what's their reason for being in a business, and how you can help them get there.
Mm.
Of course, while making sure that they comply with their taxes and all that in time.
Yeah.
And this is where the key of technology is having your team to be able to do things in time so you can present that quality information and
Mm.
have those discussion point when you actually meet the client.
Yeah.
So
Very
that's where the
important.
deliverables come in.
So I heard you talk about foundations in the past. So what are some of the maybe 2 points or 2 items that you might think? What are the key fundamentals and the foundations that you would always recommend to a small business or even an investor on getting that ready before they take that next step?
I mean, if someone's in their startup phase,
Mm.
if they want to start a business, so they're just in the beginning of their journey of starting, two key things: systems and discipline. For when I say systems, I may sound very complicated. No, system means keep it simple. Have a system in place. If you're a business, have your zero set up, have your QuickBooks set up, just your bare basics, and do what you need to do in that.
Mm.
So, or even a spreadsheet. If you're an investor, just have a spreadsheet. You need to understand where you are in terms of you need to understand some level of numbers and the discipline. Just having a system there does not really help if you don't have a discipline to actually feed in or check the information once a month, once a quarter, once a week, whatever you want to do. Compare it with your expectation.
Mm.
If you probably would have, if you're starting a business, you would have at least set some goals for your business. Are you tracking on those goals? Having system and discipline, as long as you're consistent, you'll get there.
Yeah, I mean, Xero, obviously, a lot of software, accounting software packages is an easy start for a business, but even an individual, I mean, now with the amount of applications are out there, even the Excel spreadsheet now, you can do it on your phone.
Yes.
Just, we have access, you have access, you can go in through these software portfolio tracking that we would use, for example, and put everything in there and track that with the client and annual reviews and things like that.
Exactly. That's where the discipline comes in. Just
Mm.
doing that consistently.
Mm. And have you, when you've seen I'm sure you've seen a difference between, let's talk about small business for a minute, someone who does take that on board, sets up that foundational base, uses technology to enhance and to speed up their tracking mechanism, let's say Xero, for example, and people who don't? You often, I'm assuming you see quite a big divide in success potentially.
So let's put it this way: having a system in versus not having a system is like taking a knife to a gunfight. You're in a business. As a small business, and this is overwhelming for a lot of businesses. When you think of, yes, I want to be in a business, it's an exciting thing that, yes, I want to leave my job. I want to be in a business. I will do something on my own. But when you actually get into a business, there's so many things you have to track on a daily basis. Not necessarily track, manage. There's a lot of administrative stuff. Could be to do with your employees, could be to do with your clients, your customers, your cash flow, your banking, your insurances, your invoicing, your reconciliation, your accountant. And it, on a daily basis, it gets overwhelming for a lot of businesses. And this is a reason a lot of business owners sort of struggle to meet the ends, because they just bogged with this whole day-to-day routine of running the business, and they're always behind. So having a system in place, partially automating something if you can, as I said, keep it simple, have something in place right from the beginning. Because when you do something right in the beginning, you have time to learn that. You're not starting a $20 million business right from the first day. When you start a business, you got roles and responsibility as a business owner. You will have some time to learn those things. But as you get busier, it's more complex to implement new tools and learn them.
Very true.
Yeah.
And talk about, businesses then reaching that, let's say, stage 2, start making, we hear this all the time, making good profits, taking money off the table, good sales, for example, good revenue, but cash flow is their problem.
Yep.
How do you help? What's the kind of some of the tips that you would see of the good businesses do well by managing that cash flow?
Cash flow is the most important thing in the business. I strongly, when I have meetings with the clients or business owners, or in even a conversation in general, the important thing is to understand the rule of micro improvements. How often are you invoicing to your clients? If you finished a job, are you invoicing today, or are you going to wait for your admin team to send an invoice next week?
Yeah.
Everything that you do in a business, incoming, outgoing, your decisions is going to impact your cash flow. So when I say rule of micro improvement, if my invoicing is done a week later, once the job is done, I'm going to get paid a week later.
Yeah.
So for trades, a lot of trades in construction space, I recommend them as soon as you finish the job, the applications that you see, Xero, all other applications for invoicing, it's in your phone. You can literally invoice on the spot. And once you've invoiced, what terms you have on your invoice?
Yeah.
Are you making sure that your customers are following those terms? Are you chasing invoices if they're not paid? What other improvements are you doing? Are you testing price improvements in your model? So this was an example I was giving in my last cash flow coaching class. I run cash flow coaching classes at times for small businesses. How often do you review your prices? And how receptive your customers are when you actually say, I'm going to increase my price. So if you have a customer and you've got a long-standing relationship with the customer, or customer likes you, even if it's your first, second transaction, if you've given a quote of $1,000 to deliver something to your customer and they already like you, do you think if you say it's going to be $1,010, they're going to say no? I'm just asking your personal opinion.
No, absolutely not.
Do you think just $10, which is 1% of $1,000, is going to be a deal breaker for a customer? And same applies if it's $100, if it's $101 or $1 million, $1,000,000. Are we asking that question to our customer? Because what happens is, if your bottom line is 10% of your business, having to increase your price by just 1%, it's going another 10% in your bottom line. Almost 10%. Because what you've just done is you've increased just by 1%. That $10 has gone directly to your bottom line. So your profit might double if you just implement the simple strategy. So that's another one micro improvement. How often do you review your expenses? We sign up for subscriptions that we don't even use. How often do we review? And especially as a business, when you have staff, you're signing up for applications, per application, per seat, per month, and you end up having tons of applications that half of the team is not even using.
Yeah, funny you say that. I just got my Microsoft licensing bill the other and had 35 license on them. Like, we only have 15 people. Where do I have 35 from?
Exactly.
But obviously I don't, the outsource company that runs it for us, it's not their job to look at that. They just send the license thing through. So yeah, it's a good point in looking at these things. CRM and going back to your point about technology. Now we've moved to a new CRM recently, which is a massive project, but all the third-party applications that I'm using, one by one, will be getting switched off because I can do it all inside.
And what's going to happen once you switch them off?
Meaning in terms of, well, the cost savings are huge.
Exactly.
Yeah.
So that's a cash flow you're adding to your business.
Yeah, yes.
Not just cash flow, you're also adding profit. So of course, profit and cash flow could be two separate things.
Yeah.
A lot of people get confused between profit and cash flow. And I always say the key important thing is, so your turnover, your profit, and cash flow. Your turnover is what I call your ego number because you always want that higher.
Yeah.
Your cash flow is your existence. If you don't have a cash flow, you will cease to exist.
Yeah, I like
so
that.
focus on your existence. Once you feed your existence, you can feed your ego.
Very good. I like that. It's a good segue. Let's talk a little bit about property investors. So obviously we're coming at the back of tax time now, and a lot of people are getting their group certificates. I'm sure you're hounding people to put their files together for you. What are some of the basic tips for a property investor? Maybe I'll have one or two properties. From a tax perspective, what should they be looking at to ensure they got the foundations right, and then to look at some strategies on potentially saving tax or improving their tax standings?
I mean, from a property perspective, the important thing is record keeping is the most important thing, especially when it comes to property. Because as a property investor, you may have a property in Queensland or a property in Perth. You may have an agent looking after one property, and the other property you might be paying the bills yourself. And most often what happens is a bill comes to you, you've asked your partner to pay it, or you've paid it from your credit card. You've not kept a record of that. Small repairs, a cleaning job, a pest control for your investment property, a council bill, or whatever the bill would be.
Yeah, we have to do pest and building sometimes, or smoke alarms every year, your insurances, all these basic things. Yeah.
So keeping record of all those invoices, keeping record of all the expenses. So when it comes to tax time, you can actually summarize that for your accountant to claim it. So that's one key thing that I always say, okay, well, keep record of expenses. That's going to help you in the taxes.
Yeah.
The other thing is any cost related to property. Now going back to, because tax is one part of the equation. If I'm paying $100 extra, which is I'm negatively geared, if I want to claim this, yes, I'll be taxed at. If I'm 40% tax bracket, I'll get 40% tax benefit out of that. But there's the other part of the equation when it comes to property investors. Are you actually reviewing your costs related to the property? Going back to our first conversation, are you reviewing all the expenses? Because when you're an investor, don't think you are an investor. Think yourself in a business of a property. If you got more than two properties or two investment property, you are in a business of property investing, kind of.
Yep.
So you need to look at all the expenses related to property as if they are your business expenses. Review those expenses. Have your property management consultant increase your fees. Are they managing it well? Are they looking after the property? Or is your repair and maintenance cost going higher and higher every year? Why that is happening? Are you reviewing your finance cost? Because every dollar is going to add up. And in terms of property, depends on what your holding cost is. This is where you need to strike a right balance.
Yeah.
So keeping documentation, reviewing your expenses will make a big difference at comes tax time.
Yeah, and I'm sure you work very closely with a lot of their finance side of it as well, right? Because like you said, have a look at your interest rates.
Exactly.
Do you need to refinance? Can you then improve the cash flow by doing something like that as well?
Exactly.
And in terms of, one of the, I guess, some of the trends we're seeing, just trying to think where we're probably the biggest one we're seeing in the last 24 months is investing through the self-managed super fund, SMSF. What are you seeing? Because obviously you're getting a lot of people coming to you around that. I'm tapped out, or I've reached my limit in my personal names. Do I look at setting up a trust, which is a very common buzzword at the moment? People don't understand why they even do that, or if it's beneficial to them, especially if they're a pay-as-you-go earner. And the second part is SMSF.
I'm seeing a lot of people moving into SMSF environment because it's becoming very common knowledge, especially the ones who want to take control of their investment, or especially who want to invest in property.
Yep.
Because the key difference is, unlike your industry or a retail fund, you can invest in asset classes that you can't invest using industry or retail fund. For example, SMSF, you can invest in property. You can leverage, you can borrow money in your SMSF if you want to invest in property. But again, it comes with its own complications, the structure. But most importantly, if you are thinking of SMS, you got to look at, if you're a property investor, and most people set up SMS because they feel stuck in their borrowing capacity or other reasons they want to tap out. They want to use the cash or money sitting in the SMSF and buy a property in SMSF. We still have to look at the overall strategy. Overall strategy when it comes to investing, overall planning. And when I say strategy from investment point of view, especially from property investment point of view, I usually break it down to 3 key questions. The strategy piece is based on your situation. I call it SIS analysis.
I love all the acronyms.
Your situation
Yep.
and your intention. And then based on your situation and your intention, we define structure.
Mhm.
Now, structure could be SMSF, structure could be family trust, unit trust, company. So when I say situation, now situation could be, are you a family or you a single person? Are you a business owner? What's your risk appetite? How risky you are as a person? Are you running a risky business? How old are your kids? Are you running out of borrowing capacity? These are all your situation based questions. You can't just say, oh, this is the right thing or wrong thing. And then your intention about that transaction of a property. Are you buying this property to hold it for next 10 years? Or do you want to buy this property to give it to your kids? Are you going to develop this property? Are you going to subdivide it? Is it commercial? Is it residential? What's going to be the LVR on this? That's your intention. So based on your situation and your intention, we define a structure. And then that structure could be SMSF.
Right.
But SMSF has a bit of a element of financial advice or financial planning piece in that, which we don't provide, has to be done through a financial planner. But yes, going back to your question, SMSF is becoming very popular because you can leverage up to 70 to 80% of your SMSF when it comes to buying property. So anyone who's a savvy property investor and they run out of borrowing capacity or cash to do the transaction on their own name, they move into SMSF. Now, the complication is you got to be disciplined in terms of the rules and responsibility that comes with. You cannot touch this. It has to be maintained for your retirement benefit purposes. So any transaction that you do in SMSF has to stay there. The money coming in and going out needs to be in that SMSF environment. But look, the other thing I would like to also emphasize is be cautious when you're setting up an SMSF. I've seen people setting SMSF with $50,000, $60,000, $70,000 balance. You have to weigh the pros and cons. You have to do a cost benefit analysis as to what you are trying to achieve out of this.
And they try to, what about auditing things? They just,
there's a compliance cost.
Yeah.
There's an annual compliance cost. That's where the cost benefit analysis needs to be done, because there's an annual maintenance cost and on compliance cost. You have to lodge separate tax return, separate financial report. It needs to be separately audited by an external auditor, which means unless you know exactly how it operates and what's your roles and responsibility as a trustee and a director is, don't get into that.
Yeah.
So this is where your accountant or your advisor can help you understand how you can navigate that.
What are some of the things you can't do in a let's say around property? Just focus on property in an SMSF. I hear a lot of conflicting thoughts, and people speak to barbecue talk and come and see me and say, "Oh, my friend did this." It's like, well, we can't do that. We know that for a fact. What are some of the things that you know that can't be done in?
Well,
SMSF?
first thing, and this is again coming from a barbecue talk.
Yes.
People talk about, oh, you can buy a property, and then someone wants to buy their first house and they're thinking, oh, can I use SMSF money to buy my first house? No, you can't. The property in SMSF has to be owned by SMSF. You cannot use a property. You cannot live in that property.
Yeah.
It has to be an investment property. So that's one thing you can't do. You can't buy your own house using SMSF. The other thing, any property that you buy in SMSF has to be a single contract. You can't buy a land and a house package when there's a borrowing involved. So you can't do that. and of course, as the situation gets and the SMSF environment gets more complex in terms of what you can and can't do, there are other limitations.
Renovations.
Renovations, yes and no. This is always subjective. You can do renovations with if you have enough funds in the SMSF.
Your cash balance, yeah.
If you got a property and you got $200,000 sitting in SMSF, not in a Bay Trust, in SMSF,
Yep.
yes, you can do renovations.
Mm.
But if you don't have money, you're going to borrow the money. You cannot borrow money to change or make property improvements. In simple terms, you cannot borrow money in SMSF to improve your property.
Yeah. Yeah, because we hear it all, right? Every day talking to different investors and what they hear on the street. And all of those points you just made are the ones we hear every day. It's like, no, you can't do that. No, you can't do that. Even the house and land package concept you just said, one contract.
Yeah, it has to be a single contract.
Yeah, so they will go to a salesperson and they'll sell them that one contract, unbeknown that they've loaded it up by an extra because someone's got to fund the interest.
Someone's going to fund
so you've got at least
the land holding while the construction is happening.
On top of that price, leave alone the commission on top of that sale. So when you go to get that valued, you've got a problem potentially, right, to make up that gap.
That's another challenge. The borrowing in SMSF is not based on the property. The borrowing in SMSF, yes, you might get rental income from the property, but you got to look at three factors. Is the valuation going to stack up, as you mentioned? If they're buying puffed up house and land package into a single contract because someone's paying the cost for finance, is the valuations going to stack up? Now, the other key component of SMSF's borrowing capacity, SMSF on its own, what's the income in SMSF? Income is the contribution your employer is making, you're making, or your partner's employer is making, and your partner's personal contributions. If you're not contributing enough, or if your salary is not high enough, you may not even have a borrowing capacity in SMSF environment. Because any borrowing capacity, your personal borrowing capacity is based on your income. SMSF's borrowing capacity is based on SMSF's income, which is, again, the contributions or rental income.
Yeah. Yeah, I mean, there's a lot of thought that needs to be put into that. And I think people just think, oh, we'll just use that side of their ledger because it's some money they don't really see, right? So, yeah, it's an important one that we're seeing growing. It's great for our business in that sense, but we're also really clear on ensuring they get the right professional advice before they come to us for that aspect. Search Party Property, nominated by REB as Australia's best buyers agency and buyers agent for 2025. Looking for your dream family home, a prime commercial property, or a smart investment? We've got you covered. Unlike others, we don't rely on selling agents or property managers. We have boots on the ground in key investment cities across Australia. Powered by data-driven insights, we give you the edge to secure the best deals. Ready to invest smarter and grow faster? Contact Search Party Property today for a complimentary discovery call. Mate, another question that comes often to me is around, people saying, oh, I've hit the ceiling, I've hit my limit. We talked about before, that's why looking at self-managed super funds. What are some of the strategies that people can look into when they've hit the ceiling in their personal name? So normally with us, they've got the family house and then they come and we buy them a property or two and then they've kind of tapped out. What's the next thing they can look at depending on their circumstances?
It's debatable. And this is where the whole piece of strategy comes in. Most people are trying to do DIY thing that I will max out on my capacity and then I will go to an advisor who will tell me what do I do now. And this is where 95% of people would go wrong. Once you've maxed out your capacity, then it's too late.
Yeah.
The strategy piece, which is your situation, intention, and structure, and this is where the last piece is the structure. Based on your situation and intention, you have to set up structures right from the beginning. Setting up a structure is not about just taxation. Setting up a structure to grow your investment solves three key issues. It solves your borrowing capacity problems, depending on what assets you hold in that structure. It solves you a lot of tax problems because it could be very optimized structure from a taxation point of view, based on your situation, of course. And of course, from an asset protection point of view. So, example, I've spoken to a lot of mortgage brokers, finance specialists. If you hold properties, and this is as per policy, current policy of a lot of banks. So, for example, if you hold a property in a family trust structure or any trust structure or any entity which is not your personal name, and as long as that asset is generating enough income to cover the finance cost or cover the expenses of that property,
Yep.
banks are willing to isolate that loan away from your borrowing. However, what happens is when you go and set up a structure, the first property that you're gonna put in that structure, that very first property on which you probably want to borrow 80%, that first 80% borrowing or whatever the borrowing amount is, that's going to be based on your borrowing capacity. And then once that asset is trading or able to cover the cost, then you can isolate that. And this is where you need a proper mortgage broker, a banker to help you navigate that.
Yep.
But the issue is as when they run out of borrowing capacity and then they're going to an advisor to set up a structure, then it's too late. Why? Because you already run out of the borrowing capacity. Even if you set up a new structure today, how are you going to fund the property or an asset or investment in that structure? So that's what the challenge is. And that's when people jump into SMSF, because SMSF is a last resort of not last resort. It's a separate thing altogether where you, which is not reliant on your personal income for
Yeah.
borrowing.
Correct.
But then again, how do I keep buying properties in SMSF? That's another challenge, right?
Yeah.
And again, this is where the whole strategy around numbers, the planning phase, comes in. But you need to set your goals first. Then, of course, have the don't. I always suggest people don't do it over the barbecue. Don't DIY.
Just have a
Don't
few
make
dollars, right?
Yeah, don't wait till it's too late because it's too costly to fix. It's
Yeah.
too costly to fix.
So I'm assuming that's one I see a lot. So they do DIY, they do listen to their friends at the barbecue, and they say we set up a trust. I said, why is that? I don't know.
Yeah.
Asset protection. What do you do for a job? I work for the bank. I'm pay as you go earner. So what assets are you protecting? Who's going to sue you? You work for a big company, a big corporation, wherever you work. There is no asset protection requirement there, as opposed to clients who are doctors, business people like us. Then it's a different story, right? Even though we do have insurances. Is that one of the most common ones you see coming to you, or because they've already made that mistake is what I mean?
The answer is always interesting as to why they did that or why they even come to us for at the first place that, oh, I want to do that. Why do you want to do that? Asset protection or this or that. But trust has become like a go-to use structure for a lot of people because, as you said, few people have set it up and they've spread this word over different barbecues and everyone wants to do it. But is the trust right structure for you? Now, what kind of trust? Is it a family trust? Is it a unit trust? Is it a fixed unit trust? Because people don't understand the dynamics that we only look at from asset protection or taxation. Well, there's other types of tax. There's land tax. If you set up a wrong structure in a wrong state, you probably be hit with a land tax.
Yep, thresholds and all sorts
Exactly.
of things.
So, example in New South Wales, if you still have a land tax threshold available on your personal name, you still have a borrowing capacity, you're not a high risk person, you probably be better off buying a property on your personal name versus buying it under a family trust, especially when your kids are 2 years old, right?
Yeah.
If it's $1 million land value, you're paying $16,000 land tax until your kids probably be ready to have the use of that property under estate planning or asset planning for future reference. So you would have lost a lot of cash flow. If you're a high income earner and you locked in a property in a trust, considering, yeah, that's fine. I want to asset protect. I want to protect my borrowing. I'm happy to pay land tax. Now, all that negative gearing is locked in a trust. It's not helping you from a tax perspective.
Yeah.
So scenario based analysis is the key. You can do scenarios yourself if you're a number savvy person, or if you want to just purely base it on a Google information and search.
Yeah.
You have to do a scenario based analysis as to where you are, where you want to get to, which structure is best for me now versus how much I'm going to lose or win or gain out of having a different structure. So importance of structure is key. Yes, sometimes it's worthwhile having a structure even if it's a costly exercise for you from an asset protection point of view, or if your kids are already close to 18 or 18 or above, then it might be a very different strategy for you because you can pass on the income to your kids based on your structure and advice.
Yeah. Speaking of kids, something we hear a lot of now, where there's that buzz, the bank of mum and dad. Parents are now looking, how's my child ever going to afford a property, let's say in Sydney? And, do we need to help them? What are some of the considerations from that side of it? So you used the term before, future planning for generational wealth and things like. What are some of the things that parents should be considering in that instance? Like, firstly, you can't just give your son or daughter a house.
Yep.
You can't just give them a gift of money. What are some of the things they should consider in speaking to a professional around that?
Look, a fair bit of this advice falls under estate planning and financial planning. Of course, taxation needs to be looked at as well. What I'm going to say is not a financial advice, but
No.
I have seen a lot of clients, parents becoming co-guarantors on their kids' property. They're trying to push them to buy an asset, get into a smaller purchase early in the stage when they are 18, 19, 20, 21, having their first, second job, just to push them into an asset where they will fund some portion of that depending on each family's personal situation
Yeah.
and be a co-guarantor.
Is that generally an investment, Manpreet, or is that something to live in?
It's generally an investment.
Yeah,
This is what I've seen
Yeah.
because depending on, again, some kids leave their family homes as soon as they turn 18, and I've seen some kids living in their family homes with their mom and dad or even grandparents in their 30s.
Yep.
So depending on how you want to what's your
sometimes
family
culturally,
dynamics,
yeah,
it's a
cultural
cultural,
differences, yeah.
yes. But I've seen a lot of parents now becoming co-guarantors with their kids when it
So
comes
they're
to
putting their house up as potentially their principal place of residence. Is that right? Which they may have paid off or have a huge amount of equity.
Yes,
Yep.
yes. This way, because the challenge for the kids is, can kids borrow money,
Yeah.
right? So this is where parents need to be co-guarantors on the loan, so kids can actually get into the transaction.
Especially at the age you just mentioned there, under 25 and still got a HEX debt.
Yes,
They still haven't really reached they're not climbing the ladder yet in their careers at that age.
yes.
Beginning to make some moves. But yeah, where are they going to get the money to save that big deposit firstly?
So parents can support in the deposits or being a guarantor.
And what are the risks that a parent should think about there? Obviously, we all love our kids. What are some of the risks there for a parent to consider?
The risks, again, from a family dynamics point of view, so there's two key risks, right?
Yep.
You are a co-guarantor on your kid's property. Now, this is again a bit of a legal, which I'm not qualified to advise on, but what I've seen is you are a co-guarantor on a loan, which means if your kids can't pay the mortgage, you're liable for that loan. Two, because the property is in your kid's name, and as a young kid, he will get into, or he might get into, or he or she might get into relationships or multiple relationships, a long term, short term. The risks of having that transaction, as you probably can appreciate, that relationship can go north or south, and those assets could be at a risk. So this is where how you want to structure that asset for your kids is also based on a situation and intention. So if you really want to support your kids having a property, if the kid is having that as an investment property, you probably want to protect that investment property, not from a guarantee point of view, but from their spouses right in the beginning, unless, of course, they're in a very solid relationship.
Good advice. And I mean, look, I'm not trying to get into the legal side of it, but yeah, we've talked to a few lawyers around that angle. And I think what we're really saying here is you need to get specific advice for the intent of what you're looking to invest in, and also the experts from a legal perspective and a finance and accounting perspective.
Exactly.
So in ending, what sort of one tip would you give to, let's talk about property investors now. What's one or two tips you could say best to prepare them to take that next step? So there's a lot of people listening here, haven't quite made that move, a little bit nervous, a bit of trepidation, but now we're seeing the markets moving. Government's announcement a couple of weeks back around the first home buying grant. We've got very, very busy in the last couple of weeks, and I'm pretty sure that'll continue on towards Christmas. what are some of the things that they should consider to get ready if they are to make a move into property investing, if it's right for them?
From investment point of view,
Hmm.
I don't deal much in terms of people first time buyers, but from investment point of view, if you are going to be a first time investor or you are a seasonal investor and you're investing more into properties, ha- have a pen and paper, write down your situation, what can impact your situation, positive or negative, what's your intention, what's your goal, and then using that information, set up your structures properly. Why? Because if you are a seasonal investor or seasoned investor, not seasonal investor, and you want to get into multiple properties, you need to have the structures in place, proper structure in place. Because sooner or later, the biggest challenge is people run out of borrowing capacity. And if you're a first time investor, make sure you thoroughly have a record keeping process, because comes tax time, this is going to come very handy.
Yep.
And review your numbers year on year. Review your interest rate, review your cost.
Even basic things like your credit cards, right?
Yes.
I was talking to a young investor on the weekend actually, and he said he had 3 credit cards. Like, what for? He said, I don't know, I just had one when I was in Europe, and then another. You got 3 cards. He said they're all zero balance.
But it does impact your borrowing capacity.
Correct.
So the way banks look at credit cards when it comes to borrowing, they don't look at if you don't owe anything. Whatever limit you have on your credit card, and whatever that limit's gonna impact on a monthly repayment balances, if you were to use the whole limit, that's gonna be impacting your borrowing capacity.
Yeah.
Having an offset account, although it's debatable in terms of, oh, why should I have an offset account in my investment property? If you don't have your own house, if you don't have your primary place of residence, and you only got an investment property, having an offset account and keeping any savings that you have in an offset account in the investment, it's still better in terms of your net cash flow at the end of the year after tax, versus keeping it in a savings account, which is giving you 2 or 3% interest, and you're paying tax on that. Because would you rather have a negatively geared asset, or would you rather have a positively geared asset, which means you give me $1 and I'll pay 40 cents tax, or I'll give you $1 and they will pay me 40 cents back?
Yeah.
Which situation's better?
Pretty simple math, right?
Exactly.
Yeah. Well, mate, thank you so much for your time. That
Thanks for
was
having me.
a lot of gold that you've shared with our listeners. I'm sure a lot of people would love to reach out to you and dig deeper into that generic discussion that we had today. But yeah, we'll put all your AceBiz information and your contact details in the show notes. And yeah, thank you again. We'll have to get you on again and dig deeper in a few different, maybe a few scenarios, actual case scenarios that we can go through together.
Sure. Thanks, Julian.
Thanks, Manpreet. If you enjoyed the show, it'd mean a lot if you could take a moment to rate and review it on your favorite podcast platform. It really helps us reach more listeners like you. And don't forget to hit subscribe so you never miss an episode. The Invest Smarter, Grow Faster podcast provides general information and commentary about property, finance, and investing. It does not constitute financial, legal, tax, or investment advice tailored to your personal circumstances. Before making any financial decisions, you should seek professional advice from a qualified advisor. While we aim for accuracy and quality, we cannot guarantee all information is complete, up to date, or free from errors. Past performance is not a reliable indicator of future results. Thanks again, and I'll catch you next time.